So what is the solution?
Good question. Analysis. So in that particular point of view, we've got to have a method of analysis that is comfortable, easy for us to do, objective, and allows us to be consistent. But that's not good enough, is it?
No, it never will be all on its own.
That's it. So paired with that, we've also got to have a mindset that enables us to execute that form of methodology with consistency in all market conditions.
And this is not unique to trading, to active investing. It's generic to any walk in life, any sport, any business, whatever. What's the percentage between process and mindset? Where's the break? Is it 50-50, do you reckon?
Well, it's a good question. I think more and more that the psychology is probably 90%, even more than that. And the actual process, once you've got a process that's objective and something that you can repeat, then there's nothing to stop you from achieving great things as long as you've got the psychology to go with it.
Correct. And, in past webinars over the years, I've gone and sought from other walks of life, sport and business, and that what the breakdown is. And I think the consensus amongst the quotes I found is that no matter what you do, trading, not outside of trading or active investing, is that it's 90% mindset and 10% the analysis, the mechanics side of things. But you're not going to get to that mindset without the mechanics. It's the main stepping stone, right? And that's so we have to solve that first. And you have to continue to probably improve on that side of things, but it's never going to probably get greater than the 10%. So let's just talk about analysis generically.
Right. If you ask me to distill trading down to its simplest form, I would say that it's pattern recognition and numbers game. We use market analysis to identify the patterns, define the risk, and determine when to take profits. The trade either works or it doesn't.
So that's in Mark's book, Trading in the Zone, the analysis section of it, saying it certainly is the simplest, take it right down to its basic level, and that it's needed. You can't play this game without doing analysis. Okay, the how you think component.
Okay, the defining characteristics that separate the consistent winners from everyone else is this. The winners have attained a mindset, a unique set of attitudes that allows them to remain disciplined, focused, and above all, confident in spite of the adverse conditions.
Yeah, I think Mark chose the words adverse conditions there very specifically, because it's easy to have the mindset he talks about there when your portfolio equity curve is going up and up and up and the market's in a raging bull market. We only get tested when we go through adversity.
I've often used the parallel of driving a car. You only get tested when the road conditions change and you're not used to driving in that, and how you adapt and whether or not you actually can drive with consistency, patience, and be peaceful.
Correct.
But the risks inherent in trading do not cause the best traders to lose discipline, focus, or their sense of confidence. If you're unable to trade without the slightest bit of emotional discomfort, specifically fear, then you have not learned how to accept the risks inherent in trading. It's a big problem because to whatever degree you haven't accepted the risk is the same degree to which you will avoid.
That's it right there, isn't it? We'll talk in a moment about what those risks are. And I think just remember that statement is the degree to which you haven't accepted the risk is the same degree to which you're going to avoid that risk. And the problem is that the you is not your conscious mind, it's your subconscious mind. The subconscious mind is what is avoiding the risk. And because we equate emotional pain to those risks. So when those risks happen and we feel emotional pain, our automatic pain avoidance mechanisms kick in. And they do our bidding for us, not our conscious mind. And all analysis, when you're at level 1, 2, and 3, is being done in the conscious mind. When you get to level 4, that analysis is now converted into the subconscious mind and it becomes innate, which is why we want to try and get it there. But when your analysis is in the conscious mind, you're going to be equating the emotional pain to the analysis. And it's not. It's because you can't analyze away the emotional pain. You have to redefine the way that you view that emotional pain and de-energize all the feelings, the negative feelings that come with it. You have to redefine those away from how you think, not from how you analyze. And that's why it is so key. So until you resolve that, you are automatically, subconsciously going to be avoiding that risk in the same way as you might for other risks that you perceive in other environments that you operate in.
Trying to avoid something that is unavoidable will have disastrous effects on your ability to trade successfully.
And replace trade with whatever else in other environments that you're in, trying to execute a golf shot. And this is where I applied this and whatever else you do. So what are the risks? So just quickly going to step through these risks. Obvious, losing in a single trade. This one's probably a bigger one. that risk of your portfolio drawdown, your portfolio equity curve going south, you
can't avoid it.
Every single one of us will be experiencing that now, unless you're a very competent shorter of the market, and that happens over a period of time. And we can't. When we get into the environment of a portfolio value having dropped for some time, again, dependent mainly on the market is the biggest determinant of that. We can't make our equity curve go up when the market's going down for a long period of time. So it's not the analysis that's going to solve that, because there are no winning trades, or very few winning trades that are happening in the market. And so how do we resolve that? How do we reposition and redefine that so it doesn't take us out of the game altogether?
They're giving back lots of profit in a closed profit trade.
Obvious one as well.
Missing out on a profitable trade.
One that there's a whole bunch of reasons you could miss out on it. And if you're reacting negatively and frustrated and angry at those sorts of things, then you haven't resolved these conflicts going on in your mental environment.
Early exit from a trade and losing out on more profit.
That's fear of missing out, probably the leaving money on the table.
So FOMO in that particular.
Correct.
Being proven wrong.
Which is when you're proven wrong when you actually exit the trade. Otherwise, you're not wrong until then, and even if it keeps going down.
You're not going to know that in advance in any case.
Absolutely, because we don't know what happens in the future.
And making big mistakes, often starting off with small ones.
Correct. And that's us not trusting a whole bunch of things. So these are risks. These are the risks that you would automatically try and avoid. And by the definition that we're going to bring to you over the coming sessions, is that the very act of trying to consciously avoid those risks by doing something you shouldn't do is a mistake. And we'll qualify that more. So how do you try and avoid the risk? These are the mistakes that you'll make.
So not taking the trade when you set up analysis signals to do so.
Whether that's mechanical or not, if you think you're an intuitive or subjective trader, then that's the same thing.
You take yourself out of that process.
You take yourself out of the process,
Taking the trade with too smaller or too large a position again.
Yeah, that's either too big. There's when you get euphoric and you think you get into a riskless state of mind, and you only see upside, and you put too much into the trade.
Exposure is too low over the life of a portfolio. That can happen.
Yeah, we were discussing that just yesterday with one of a portfolio equity curve that we got to see where what happened is every trade had been taken mechanically.
Every trade, in terms of execution, was actually pretty good, but the issue was that the portfolio was only exposed about 40% of the time during big, strong, rising markets, and then another time only about 60% of the time, and that was just basically that was a big risk. Positions
were too small. The money wasn't being used. It was profitable, but nowhere near as profitable as what it should have been because the exposure was too low. And what happened there is that in psychologically is the analysis, the process portion was being followed, but not putting in the position size for the size of the portfolio. And so all the trades got done, but the position sizes were too small. So effectively, if you'd taken half of the initial portfolio size and used that as your measurement, you would have been doing great because basically the position sizes were all half the size of what they should have been.
That's right. Taking a trade when you set up analysis is not present. So second guessing.
Correct. Yeah.
Jumping out of the process again.
Reacting to noise and forums and that sort of thing. Yeah. Not part of your process.
Not defining the risk on every trade for when to exit. Again, we talked about big losses. They all stem from small losses.
Correct. That's right. Yeah. Every small loss trade is a victory against a big loss trade.
Not exiting a trade when your analysis signals to exit. I'll just give it one more day. I'll just wait.
Because you only lock in the emotional pain when you sell. So we can avoid that emotional pain and avoid that risk of being wrong and losing by staying in the trade and not taking the exit signal.
Exiting the opportunity flow altogether against the rules. So what does that mean? It just means just stepping out of the process, does it?
Just step out of the process. You go from being a player in the game to being a spectator. While you're a spectator, you got $0 at risk. And so there you're avoiding the risk of losing, of being a drawdown, of missing out, of all those sorts of things. You just become a spectator and you go into, you basically go into excessive caution mode. And the quotes that we put up from John Bogle and correct. Yeah. So we don't want to do that. So we have to learn how we stay in the opportunity flow while truly, as a part of who we are, accepting all the risks from the environment in which you're operating. And that is not an analysis solution. It's a mental skills solution. Okay, so how will you accept the risks?
I don't think I could put the difference between consistent winners and everyone else more simply than this. The best traders aren't afraid.
Tough, which means you overcome fears.
Yeah.
get into a lot more of that. So how will you accept the risks some more?
Learning how to redefine your trading activities in a way that allows you to completely accept the risk is the key to thinking like a successful trader.